Good morning and welcome to the final webinar of 2020. My name's Sarah Hare. I'm the Senior Marketing Manager here at BetaShares, and I'm delighted that so many of you could join us for this final session, 2021 Outlook and Opportunities. Just before we start, a reminder that anything we're talking about today is general in nature. We're not taking into account any personal circumstances. So anything that we do mention, please do your own research and before you make any decisions. Also, we've left plenty of time at the end of this session to take questions. Please use the toggle on the right-hand side, type your questions, and David Bassanese will try and get to as many as possible. A recording of the session and the slides will be sent around this afternoon as well. As most of you should be aware, at BetaShares, we provide regular content in the form of our weekly newsletter, Monday Morning Bassanese Bites with David Bassanese. We also have latest news and information up on our socials. So please make sure you do follow and keep up to date. For 2021, and at the end of this session, we'll be asking a short questionnaire and we'd love you to help us shape the agenda for 2021. Please let us know what webinars you'd like us to run, what topics you'd like us to cover, and we will be led by you on what we cover and what we present in 2021. At BetaShares, we have just celebrated our 10th birthday. So in 10 years in business, we have over 60 funds on the ASX. We have made 15 billion in funds under management, and we're an Australian-led Australian business. Our objective is to provide intelligent investment solutions for Australian investors, and we always welcome your feedback, but very much directed by you. So, without any further delay, I'm happy to introduce David Bassanese, our Chief Economist. Most of you will be familiar with David's work. He's the chair of the BetaShares Investment Committee, author and former AFR columnist. Welcome, over to you, David.
Thanks very much, Sarah, and great to be with you all for the final webinar and what has obviously been a tumultuous year for the economy and for financial markets. Just trying to, great, so just get the technical details out of the way. So here's my agenda today. I'm going to be speaking for about 35 minutes and then we'll have plenty of times at the end of it for questions. Just give you an update on the COVID situation. Obviously, it's been the big factor driving markets and the economy this year. How the economy is playing out at the moment, both globally and Australia. Just an analysis there of the market outlook and then some specific investment ideas arising out of all of this. So firstly, with the COVID situation, and again, these are some charts from the Financial Times. The first chart there is the rolling 7-day average of new COVID cases. And I've got the US, Europe, the UK and Australia down there. And the second chart is the new deaths. Look, as you can see, I mean, again, for those that have been listening to our webinars through this year, I've had caution about the markets and the economy just because of the history of pandemics is that you typically get second and third waves. If you go all the way back to the 1918, Spanish flu and then the Hong Kong flu and the Asian flu of the 50s and the 60s. And so certainly that has played out. So as you can see there, the US is now in its third and greatest wave. Europe had a significant second wave, with the reimposition of social distancing restrictions in Europe, the peak was set and that started to decline, but they're still sort of struggling with it. And even overnight, London has announced new restrictions in the City of London just because of the continuing high level. And as you can see, Australia's done very well. So this is on a per 100,000 case. If you see, so basically this allows for population size. So even allowing for population, you can see how well Australia has done relative to some of these major other Western economies. The other point there, if you look at the death rate, I mean, it has been notable that even though the second waves have been significant in terms of new cases, the death rates associated with the follow-up waves haven't been as great. I mean, still overall deaths are still horribly high, but in rate and as proportion of the number of cases, it has declined, and that's because the second waves have affected, well, more of the cases this time around reflecting higher testing, more a younger cohort being affected, and so in the first waves back in March and April, really the people were getting COVID and being reported as having COVID with the most serious cases, those arriving at hospitals in serious need of care. So that has been true, and to an extent, that's limited the degree to which renewed lockdowns have been needed. So what we've seen around the world, to a greater or lesser extent, particularly in the US, the harsh lockdowns earlier this year generally haven't been reimposed. We've seen more regional, targeted, more limited measures like restricting the number of people in restaurants, banning indoor dining. So some more limited measures, and that ultimately has also helped the economy, as we'll see, continue to recover from the complete collapse that we had in the global economy earlier this year. Just thought this would be interesting. Which countries have done better and worse in terms of dealing with COVID? And this is probably the single best measure. This is total excess deaths per million people. So again, excess deaths measures the overall death rate in a country relative to sort of the historical average, and that sort of captures not only then COVID, but other deaths that may arise, be it through the other secondary issues associated with lockdowns, be it suicide or whatever, or even if the cases being reported from COVID aren't being fully captured. So this is I guess a better measure. And what you can see here, it's actually Latin America, Peru and Ecuador, just to an extent Spain, have been the worst affected, but many European countries also in there, UK, Belgium, Italy, and then US. If you see, in terms of total deaths, obviously US is an absolute standout, but I mean, US is, of course, one of the biggest countries in the world, over 300 million people. So that, to an extent, is not surprising. But once you allow for population size, you can see the US has certainly been amongst the worst affected. And the good news is, if you look at that slide, Australia doesn't appear in that top list. So we, again, just underlies the fact that we have dealt with it, helped by the fact that we've been able to close our international borders. We've closed our state borders as needed. State governments have had a fairly, strong approach to COVID, stronger than some would like. But ultimately, it's meant that we've dealt with it pretty well by global standards. Now, if just going back to this slide, were it not for these, obviously the big news in recent weeks, and this is why the equity market is, just in the month of November, global equity markets, the Australian market was up 10%. Quite a standout month, and it's because of the two reasons. Firstly, the good news on the vaccines, like up to three serious vaccines that have very good results in late stage trials, and two have now been well, at least one at this stage has got regulatory approval to be distributed in the UK and in the US. So vaccines, as we speak, are being rolled out in the UK and about to be rolled out in the US. That's the Pfizer vaccine. But there's two other contenders that are also likely to get approval and be rolled out. Now, were it not for that, this reality of going back to this slide of these serious waves and renewed lockdowns, in all likelihood, the equity market would have been a lot weaker, or certainly not, would have been a lot more defensive than what we're seeing at the moment. But, it almost like, as I've been saying here, it's almost like a B-grade Western movie. The vaccines have arrived like the cavalry just in time because, as I said, it would be a lot more dire situation were it not for that happen. And it's come basically a lot earlier than expected. I mean, again, if you're listening to our webinars, we were saying, and most of the experts are saying, a vaccine may not be likely for a year and possibly up to several years. And even the recent budget had a vaccine arriving at the end of next year was their base case. And so the fact that it's arriving now in some countries, and in Australia it looks like being available within the first months of next year, has really, changed the situation. The other, I guess, development in terms of markets, I'll talk about a little bit in a minute, but we did have this great fear of a contested US presidential election result, that the result could be uncertain and dragged through the courts. Now, the bottom line of it, despite all the protestations of Donald Trump, is most of the authorities, the powers that be, have decided that the election was pretty clean and pretty clearly that Biden won. So the risk of a drawn-out, uncertain election result was quickly discounted by the market. So A, the vaccines, B, a smoother than feared presidential election has really helped give equity markets a lift through the month of November and moving on into December. Just in terms of the economic outlook, and look, this, again, I don't want to sound like a scratch record, but this is, and so I'll just say it and hopefully I won't say it too many more times, but this is the most critical development in global markets. If you need to remember one thing about what's going on globally, it's the reality that inflation remains stubbornly low. As you can see here, the major economies, all these central banks, all these governments, countries trying to get inflation at 2%. That's their target. And it's been failing. Countries have been failing to get inflation at 2% prior to COVID. COVID's come along, it's shocked the economy, it's pushed up unemployment, and as you can see, inflation has actually gone, in the wrong direction. It's gone closer to zero. Central banks have responded, so to the extent they had any positive interest rate left, they cut it to zero. So basically, central banks have cut policy rates, as you can see on the next slide, to zero around the world. But not only that, they are now promising to keep interest rates on hold for up to 1 to 2 years until such time as inflation picks back up again and gets somewhere close to their targets of 2%. So those dashed lines in this chart, the second chart there, are market expectations of what it sees the official interest rate doing in each of these countries. And as you can see, markets around the world are factoring in no increase in official rates by central banks for several years, which is, again, quite extraordinary compared to history. So typically, you get central banks cutting rates during a recession, during an economic downturn. When we see signs of a turnaround, they want to start to re-normalise interest rates. They don't want to keep them too low for too long. The game plan has completely changed, because now they're saying we really want to get inflation up, so we're going to keep it low. And so really it's, this is providing I guess a ramp, for equity asset prices around the world, not only house prices, but share markets, as we'll touch on in a minute. The other one, low inflation, low interest rates has also had an effect on fiscal policy, because again, government bond yields around the world are like sub 1%. In Australia, around about 1% or so. And so the cost of running up debt, you're not paying any financial penalties. Financial markets aren't jacking up interest rates out of fear of debt. And so that plus, the nature of the shock, dealing with the coronavirus, governments have really opened up their checkbooks. You can see the size of the fiscal stimulus across a number of countries. Collectively, it's been around 10%, or almost 10% of global GDP. Big difference from the GFC. You can see back in the GFC, the net change in the budget deficit position, which is a measure of fiscal stimulus, was under 2.5%, around about 2%. So 2% versus almost 10% today. So you're looking at several times bigger fiscal stimulus. We've seen that reflected in the JobKeeper programs, the increase in the unemployment benefit. So again, another reason why the economy has been able to rebound relatively well, despite the persistence of the coronavirus and consumer spending, as we'll touch on in a minute. So this is a really good summary measure of the economic situation. So what this is, aggregate weekly hours worked. Again, regular attendees to these webinars would have seen this chart in the past. And what it showed, this is what recessions typically look like historically. You get periods of a decline in aggregate weekly hours worked of around about 6% or so, and it takes place over the course of a year. So recessions historically typically lasted around about a year, which is why historically equity market declines during recessions typically last around about a year as well. So look at what's happened this year. We've had an incredibly sharp collapse in aggregate weekly hours worked, but the bottom was within a few months. So if you look at Australia, I mean, we bottomed around about March, April, May. So we had really 2 months of massive contraction in aggregate weekly hours worked. In the US, again, 2 months. But then the bottom was in. And so again, with hindsight, looking back at the equity market, that's why the bottom for the market was in within late March, because it anticipated a bottom in the economy that quickly. And as you can see, aggregate weekly hours worked as we went through the first lockdowns, we've gradually reopened, have recovered. They're not back to the levels they were prior to COVID, but nonetheless, we've had a reasonably good recovery in overall hours worked. And just to compare that with the trajectory there in the bottom line there is what's been happening this year compared with the GFC. As you can see, we're basically back to now where we were during the downturn in the GFC, but it was still ongoing for another year or so back in 2008, 2009. So very different, very sharp, but very short period of contraction in the economy, which again explains why the share market collapsed the way it did, but then bottomed and is sort of making an effort to rebound. And certainly in the case of the US market and global markets, they have actually retouched their previous pre-COVID highs. Whereas Australia, we're not quite back there yet, but certainly we've started to pick up the gains in the last month or so. Just some around the grounds in terms of data globally. So this is some Chinese indicators. You can see China really led the way here. They got COVID earlier than everyone else. They went into lockdown earlier. They came out of it earlier. They've had a nice rebound in a lot of indicators. And as you can see, one of the consequences of that for Australia has been a very strong iron ore price. So again, you're hearing a lot of newspaper reports. I'll touch on in a minute about, well, newspaper reports, but the reality that China is restricting a number of our exports. But so far, at least, they haven't touched iron ore because it's very important to their steel industry. And in fact, they're continuing to demand steel iron ore to a great degree, which is helping underpin the price at the moment. There's also an element of, I think, a fear that we may get restrictions in iron ore, and so you're getting a lot of build-up of inventories in China in anticipation of potential disruption. So at least in the short run, that's probably added to the upside in the price at the moment. Looking at the US market, I mean, initial jobless claims, these are weekly jobless claims. This is a very good leading indicator of the health of the economy. As you can see, we had that huge spike earlier this year, just incredible numbers when we look back on this in history, over 6 million jobless claims all within one week as the economy basically went into shutdown. As you can see, jobless claims have come down. They're still pretty high by long-run standards. And in fact, just a little bit of a worry that they have ticked up in the last week. So in the past week, they actually went up 100,000, back up to about 800,050 weekly jobless claims. So the rate of improvement has flattened off as, again, going back to that initial slide with COVID, US has still been struggling with COVID and there's been some reimposition of restrictions to deal with it. And as a result, the rate of improvement in the economy has started to slow somewhat. It's still positive, but it has clearly slowed. And you can see that also in the employment gains. Basically, the US has recouped around about half of the employment losses that it initially lost. But so there's still some ways to go before they get back to where they were. Australia, there's just some other indicators there. Retail, I mean, what's been unbelievable around the world is retail spending. The first slide there is US retail spending. Australia is similar. After that initial collapse where all the shops were shut, we've reopened and online shopping and whatnot. We've seen a major rebound in consumer spending. Seeing consumer sentiment, because consumer sentiment in the US still hasn't quite recovered. A big difference with Australia. Again, that's because US is in a worse situation with regard to COVID. Housing starts still going very well. Durable goods orders, that's a sign of investment, still pretty positive. This is the case in Australia. Again, we had a collapse in retail spending. It's bounced back in a big way. We've had a bit of a pullback in retail sales just in the last couple of months. Again, the Victorian lockdowns haven't helped there. But as you can see, we initially had a very strong rebound in retail sales when we did get that first reopening. And if you look at the latest numbers for consumer confidence, again, a very strong bounce back. And in fact, only we've since had an update on this, and it's gone up even further. So, you know, consumer confidence, as measured by the Westpac Melbourne Institute Index, is at 10-year highs. So, you know, consumers are feeling pretty upbeat about the outlook. You know, we've tackled the virus. JobKeeper's been helping. In fact, you know, consumers have been flush with cash because of all the government support programs. The household savings rate's been very high, and that's been helping underpin consumer spending. And again, because we've tackled COVID pretty well, people are feeling fairly confident about the future. House prices, also I'll touch on that in a minute, but that's also what's been helping consumer confidence at the moment. Again, a business survey, so this is a measure of business confidence, and that, again, that's bounced back pretty well in recent months, almost back to sort of pre-COVID levels. And various employment indicators also improving. So the NAB index, employment index, so that's inverted. So when that dashed orange line on the first chart there is falling, it means employment demand by businesses is improving. As you can see, it did collapse, but it's improved. And ANZ job ads, another measure, has been improving as well. So all that bodes well for you know, gradual continued reductions in the unemployment rate. The RBA's latest quarterlies had the unemployment rate. Well, initially going back a few months, we thought the unemployment rate would get to 10%. Then the RBA's revised that to think there'll be a peak at 8%. At the moment, it's running at 7%, and it's looking less likely that we are going to get that big spike up to 8% or so. If anything, it maybe will hold where it is, but then gradually, you know, decline as employment growth recovers. Now, one of the things that may hold it up in the short run is there's still a lot of people outside of the labour force that aren't actively seeking work, and so as they start looking for jobs and the participation rate increases, that's going to add to the challenge of the unemployment rate coming down, even though employment growth may well continue to rise. But again, the outlook is looking ever more encouraging on the employment front. Building approvals also rebounding, so home building approvals are up. I mean, the home builder program, I mean, the $25,000 grant for home extensions or to buy, it's a bit laughable really, $25,000 grant to help you buy a house. It's such a fraction of the actual price of a house, certainly in Sydney, but nonetheless, it does seem to have given the market a bit of a kick along. Home loans are also recovering on the back of very low interest rates. House prices, I mean, again, house prices appear to have already bottomed. If you go by the CoreLogic monthly survey of house prices, we basically had 5 months of decline between April and September, and it was about a 2% decline, 2% decline peak to trough for national house prices on that measure. So again, compared to some of the even personally, I expected a 10% decline in house prices, at least a 10% decline in house prices, and you know, we've only got a 2% decline. And again, ultimately, that's because we haven't had the forced selling. You don't get a big collapse in house prices unless, you know, thousands upon thousands of households are forced to sell their homes because they can't afford to meet the mortgage repayments. But due to the delay in the repayment holidays, the JobKeeper programs, the ability of the economy to rebound, at least outside of Victoria, pretty well, we haven't had that forced selling, and as a result, we haven't had the big collapse in prices. And in fact, if you look at my home loan affordability chart, and I won't spend a lot of time, I'm running out of a bit of time now, but if you look at this home loan affordability chart, this grey line shows you how affordable it is to buy a medium-priced home nationally, given current level of interest rates and household income. And at the moment, the mortgage rate for new loans for owner-occupiers is around about 2.9% on average, according to the RBA website. If you plug that into your numbers, you actually get a mortgage affordability at the best level since March 2002, going all the way back here. And what do we know that happened in March 2002? Well, in the following 2 years, house prices nationally went up by about 30%. So not necessarily saying they're going to go up by 30%, but we do have a platform where, again, if the RBA keeps rates on hold, what we do know is when affordability is good, people don't pocket the savings. They basically turn up at the auction prepared to pay more for a property. So ultimately, it's the marginal buyer that drives the property price. And so what I suspect is going to happen is prices are going to go up until that, affordability is no longer as good as it is at the moment. And that's how the market will kind of equilibrate. And that's true across the board. I've just got some measures there of affordability measures. As you can see across the country, the current level of affordability are well below in fact, at the lows of the past decade or so. So it's certainly not unique to any capital city. And again, it's been driven by very low interest rates over the past year. Just in terms of China, you've got look, a lot of comments to say here, but China is a very big export trading partner of us, over 30% of exports. So we have got in a position where we do rely on China a lot for our exports. Iron ore is a very significant one. As you can see, it's on this measure, about 60% of Chinese imports of iron ore come from Australia, and they're a big part. Our iron ore, it's a big part of our iron ore. So we're mutually dependent on each other in terms of that iron ore market. In terms of the areas that they've cut back on at the moment, beef, barley, coal, wine, at the moment that adds up to around about 10% of Chinese exports. So, still 90% of exports not affected. They're going to China. And that's around about 1% of GDP, just to put in orders of magnitude. So obviously not ideal, but at this stage it's not having macroeconomic effects, so economy-wide effects. Certainly for the specific sectors involved, it's a challenge, but I guess from a point of view of the overall macro economy, it's not significant enough. Now, obviously, if they tackled iron ore, that would be a difference. Iron ore is about 50% of Chinese exports. But I mean, if China did try to restrict iron ore exports, the iron ore price would surge, because we're a big supplier, and if they didn't get it from us, they'd need to try to get it from Brazil, and Brazil would jack up their prices in response, and it would be, make the problem even more problematic for Chinese steel mills. So arguably, China needs our iron ore so much that it's probably unlikely to restrict iron ore, but never say never. I mean, what I will say, it's hard to know how China will, people often ask, well, how is this going to play out? Well, it's ultimately a national military, or, it's a national security kind of issue that China are dealing with. So we don't know how far they will go. What we do know is it's not change. If they think it's going to change our opinions in Australia, or change what we do here, they're wrong. Clearly, government, if anything, their attitudes have hardened. And China's reputation internationally is getting damaged. So I think ultimately they may well conclude this is not helpful to them, and they may try to de-escalate this situation. But then again, maybe they won't. Maybe they see this as playing to their own domestic political, sense of nationalism, and they could continue it. So we just have to wait and see. It's clearly, one of the big risks for our economy as we head into next year. In terms of the market outlook, again, this is a slide that I put up a few months ago, and again, this is part of this series dealing with COVID. And so these are some of the risks that I identified in earlier webinars, and just really an update. So second wave risks have not gone away. Yes, but we're dealing with it. So as I said, yes, as predicted or as feared, we have had these second waves, particularly in Europe and the US, but the death rates haven't been as bad in general, and we've had more piecemeal restrictions imposed. And again, just when we thought things would get a lot worse, we've had the vaccine cavalry arrive, almost in the nick of time. So as I said here, the vaccine, no vaccine, well, now there is. So that's a big difference. And I guess generally in terms of the economy, there was a fear that when we would reopen again, that consumers and businesses would be cautious. We haven't seen that caution. I said consumer confidence has bounced back pretty strongly, and retail spending in many countries, underpinned by a lot of government support and very low interest rates, has bounced back very strongly. And that's been the big driver of Australia's economic rebound, is consumer spending at the moment. Overly bullish earnings expectations. In fact, earnings expectations, I'll show you in a minute, actually have held up pretty well in the past 6 months. So the markets are still counting on a decent rebound in earnings next year, which is very important for the equity market when we touch on that in a minute. Presidential election, again, that was a risk, but as I said earlier, smooth transition now appears likely. Donald Trump is going to probably continue to, tweet from the sidelines, but his relevance, at least over the next few years, is going to be, greatly diminished. Never say never. He's, threatening to come back as a challenger in 4 years' time. So we may not have heard the end of him, but at least in terms of his impact on US public policy for now, I guess it's a bookmark, it's a footnote in history. Can the equity market rally continue? Look, valuations are a bit stretched, but interest rates are going to likely to stay very low. And as I said, earnings are recovering, so that bodes well. So that's the scenario. Interest rates staying low, PE valuations or price to earnings valuations are elevated. They may come off a little bit, but not a lot. And more than offsetting that on a one-year view is a recovery in earnings. So that's why, even though equities have had a strong rebound, if you look out, say a year from now, it's still likely that equity prices will be higher than what they are at the moment. And just to touch on some of those, this is the global, the PE ratio is in orange. You can see it's around about 20 times earnings, a level we haven't seen since the dot-com days, the dot-com bubble days of 99-2000. Those of you old enough to remember that period. But the big difference between now and then is interest rates are so much lower. So the equity risk premium, so the earnings yield of the equity market less the bond yield, around about 4%. The low end of the range of the past decade, but still comfortably above its longer run average. And again, one of the challenges here is to know, what is fair value for the market given very low bond yields. I would argue, I think the market can probably comfortably hold at around 20 times forward earnings, maybe even go a little bit higher if interest rates stay as low as they are. The same with Australia. So our PE ratio now around about 20 times earnings. Again, level we haven't seen since 99-2000. Big difference, of course, interest rates so much lower. So the same sort of story applies. This is the important one also is the earnings story. So as you see, markets earlier this year, there was a collapse in earnings expectations for 2020 and 2022. These are what analysts expected earnings to be for those years. They've bottomed out, and as a result, the markets are anticipating a nice rebound in earnings in 2021, next year on 2020. And as a result, forward earnings, which is a weighted average of these measures, has already started to increase. And if you look at the green line, this orange line will touch this green line at the end of next year, wherever that green line may be. So if that green line holds up where it is, this orange line will continue rising through 2021. And as you can see, that's consistent with something like a 15% growth in earnings if those expectations for earnings hold up. And at this stage, it's a reasonable expectation. I mean, I was fearful of more downgrades a few months ago, but for all the reasons outlined, they've actually held up. And now with the prospect of the vaccine and whatnot, it's looking bodes well for earnings recovery next year. Same story in Australia. Again, earnings expectations for this year and next year, 21, 22, 22, 23, well above 2020, 21. Iron ore prices, the resources sector a major factor there, but just, across the board, after this big collapse in earnings, we're getting a recovery in earnings. What could go wrong? Inflation and interest rates, rising China tensions. To the extent that Democrats increase taxes is a risk. Again, Biden in control. If the Democrats win control of the Senate, there is a risk that they may want to unwind some of the corporate tax increases that was one of the first and only things that Trump did when he got elected. But it seems unlikely that they'll do that because I think the Democrats, even if there's 2 more Senate seats to go in Georgia to be decided in January. Now, even if the Democrats win both of those, it would only give them a majority of 2, which is pretty skinny. And as we know in America, they don't all vote as party blocks. And so you would only need a few moderate Democrats to not want to increase corporate taxes for that not to get through. So bottom line is I don't think it will get anything too drastic coming out of Washington that could rile the market. But nonetheless, you've got to watch and see how the elections in Georgia play out for the remaining 2 Senate seats in January, and just keep a watch on Washington. But at least the good news, at least, is that we've got a less erratic president in power. and I think we'll see more, moderate, markets being less focused on the president than they have been in the past 4 years. Investment themes. Look, just a couple of, these are some major trends going on globally. As you can see, prior to COVID, the major trends have been technology as a sector down here, quality, companies with a high return on equity, and the US market, because the US tends to have a lot of technology and a lot of quality companies. With COVID, we actually got an extra kick along in terms of that outperformance of the US and technology earlier. But what we're seeing now is the fears of COVID, along with the vaccine starting to unwind. We're seeing a bit of a rotation back to the so-called value parts of the market, such as energy and financials, and non-US markets, such as emerging markets, even to Australia to an extent. So I suspect over the next, say, 3 to 6 months, we may see technology probably will hold up. Like, I don't think it's going to collapse, but we may see stronger performance in some of these value parts of the market, such as energy, financials. Like energy, oil prices strengthen on the back of stronger demand. That's going to help the energy sector heading into next year. Financials, to the extent we get a bit of an increase in longer term bond yields, that they will be helped, but probably not as much as energy. But that's just a theme. But I actually think if you look at on a longer term view, say 2 to 3 years, I would still back technology as a factor, as a sector, to outperform vis-a-vis most other sectors. And I think what we're seeing now is just an unwind of that extra outperformance that technology enjoyed during the worst moments of the COVID shock. And these are some of our value exposures for those who are interested. I mean, in fact, Japan, if you look back here, Japan's had a very strong run of late as investors are seeking value outside of the US market. So we've got exposures in HJPN as our Japanese ETF, HEUR is Europe, banks, global financials, and fuel is global energy companies. And then we have an equal weight ETF, which weights all the stocks in the S&P 500 index equally. So they all have a 0.2% weight. And the beauty of that is you're getting a lot of smaller cap value exposure relative to, say, the larger cap tech exposure, which does dominate the typical market cap S&P 500 index. In fact, the top 5 companies now in the US S&P account for about 25% of the index, which is a level we haven't seen really. In fact, it's higher than the dot-com bubble, and it's a level we haven't seen since the early 70s. So it's a bit top heavy, and if you want to get broader exposure, that's just another way of playing that. In terms of those other things, again, if you've been regular listeners to our webinars, you know these have been my long favoured types of exposures. Again, they may take a back seat in the very short run, but I think they'll definitely come back on a longer term view, still hold very well. So global quality, our Australian technology fund, the global cyber security, hack, robotics, artificial intelligence, RBTZ, Asia, global technology companies. In fact, Asia, it's been unbelievable. It's actually up 60% over the past year. So Asian tech doing incredibly well. And then, of course, the old favourite NASDAQ, NDQ, including covering companies like Google, Amazon, Facebook, and companies like that. In terms of Australia, some of the themes, these are some of the major trends here. You see, financials have had a long period of underperformance. I think that's starting to bottom out now. So I think financials will probably at least move in line with the market now, no longer be a drag. Technology, again, it's had a very strong extra advance this year. That's going to start to unwind a little bit. Things to look out for that could bounce back nicely next year are infrastructure funds. I mean, things that like toll roads and airports, which have been hit hard. In this low yield environment, investors seeking yield. The infrastructure assets do have this, I guess, relatively, well, apart from when you have shutdowns associated with the COVID, relatively reliable income stream. And so I think we'll see areas like that come back to the fore. So our RINC fund, RINC, invests in infrastructure assets and commercial property. It's an actively managed fund, so it aims to pick the best listed exposures in those areas of the market. So that's some of the trends. I mean, resources also having, well, this chart shows it's waxed and waned. Just in the last month, it's had an extra kick along due to iron ore prices. and that, you know, I think resources and financials are can do, you know, reasonably well going forward. But in terms of thematics, you know, what's going to outperform, you know, I think maybe infrastructure as we get through the COVID crisis. And I guess my comment on financials is maybe that period of underperformance is probably behind us now. And I just noted that today the regulator has said that the banks are no longer restricted in providing dividends. So that's good news for those relying on that from the banking sector. In terms of interest rates, you know, they're going to stay very, very low. And again, it's hard to get decent yield. Our long duration corporate credit fund is offering you now a yield to maturity of around about, let me just make sure I give you the correct numbers. So long duration corporate bonds, you can get a yield, you get a running yield. It's called a running yield of 3%, but I guess the yield to maturity is about 2%. The difference between the running, well, I don't want to get caught up in technicalities here, but the yield to maturity is probably the best longer term measure of the yield you'll get from holding that exposure. The running yield is a bit higher, but that's because you're owning bonds whose capital value is destined to come off a little bit as we hold them through to maturity. But so the best measure of the yield on long duration corporate bonds today is about 2%. You know, it's still low, it's low by historic standards, but I mean the cash rate is near zero. Our AAA cash ETF is giving you 0.4% after fee. Again, very, very low, but I mean some term deposits are giving you nothing. So at least it's a positive return. Hybrids, I mean, I still favour hybrids. I mean, you do take on a bit more equity risk exposure in terms of equity sell-off. Hybrids sell off a little bit as well, not as much as equities, but getting a gross yield on our hybrid ETF of about 3.5%. Again, so that's certainly attractive. So there's some opportunities on the interest rate front. But again, the reality is that the bond and cash areas are giving you very, very tight returns for these reasons. Interest rates incredibly low, likely to stay low. And even as we see here, corporate credit spreads have come in quite sharply in the past month or so as well. So cred was offering, you know, relatively attractive yield. It's still offering an attractive yield. I mean, you've got really nice capital gains here because of those corporate spreads having come in. But you know, they're pretty tight. They may come in even more. But as I said, a lot of those gains have you know, all I would say from a historical point of view, they're already pretty tight. But that's a consequence of investors chasing yield. Look, that's pretty much it. Just to summarise, you know, what a year. But you know, look, in terms of various scenarios we outlined earlier this year, it's actually, you know, turning out to be almost a best case scenario. We are, you know, close to enjoying a V-shaped recovery. Vaccines have arrived a year ahead of schedule. The second waves were dealt with, you know, we didn't have the associated death rates in the second waves, and we didn't have to go back into the draconian lockdowns that we had in the first wave. So a lot of positives there. And you know, so obviously some risks, but I mean, I guess my key message here is it is an encouraging backdrop as we head into 2021.
Thanks, David. We are at time, but we have had so many questions. So if you do need to drop off, we thank you very much for joining us. But we will take some questions from the audience and cover those off. So a lot of questions have already been covered, but we've got a few. One from Bill. So many analysts claim the great rotation has begun with value-based stocks replacing growth-orientated ones. Do you have any evidence of this? A number of ETFs have hit some record highs. So what's your thoughts on this one?
Yeah, look, it is happening. I mean, as I said earlier, like things like energy stocks have done pretty well. Non-tech related non-US markets, emerging markets have done well. So if there, you know, if you look at the growth index, global growth index relative to the value index has outperformed in the past couple of months. Now, I actually put it down to, I don't think it is at the beginning of a multi-year trend toward value over growth. I don't think so. I think what we're seeing is as I was saying earlier, growth has been long outperforming value for several years. Then when COVID struck, growth actually outperformed even more. What we're seeing is the unwind of that extra outperformance associated with COVID. So I wouldn't mistake this with a change to that that longer term structural preference for growth over value. And so that's why I see it as more, yes, it is happening, but I think it's going to be a relatively short run affair, maybe 3 to 6 months as the dust settles on COVID. But definitely it's a playable opportunity. As I said, things like global energy through our fuel ETF, Japanese equities through our HJPN ETF, even to some extent BNKS, global financials. They're so beaten up, so unloved that it wouldn't take much for even global financials to bounce back in a big way. And yeah, so there are definitely some playable opportunities from a tactical point of view.
Mm-hmm. Quite a few questions on the currency, so that's always a hot topic. So your thoughts on the AUD/USD exchange rate, and then thoughts around hedging your investments. So thoughts there.
Look, the Aussie. Look, it surprised me by the strength. I've never been a big Aussie dollar bull. I mean, I've resisted these moves. It's kept going higher. I mean, it's like iron ore prices are a surprise to the upside because of the ongoing surprisingly strong Chinese demand and to some extent some supply restrictions that have boosted it. And Australia having done relatively well compared to other countries with COVID, and our interest rates are horribly low by our own standards, but still somewhat attractive by global standards, would you believe? And so that's helped support the currency as well. So look, at the moment, the trend still favours maybe the Aussie going up. I mean, there's talk of it hitting 80 cents, but can it go a lot higher from here? I still doubt it. And again, it goes back to this point that I think global growth, things like technology, of which we have a part in our market, but it's a very small part of our market, is going to continue to outperform on a sustained basis. And so in a sense, we'll be seen as an old economy. I hate, to use that term that was around a while before. So I do see our market continuing to generally underperform global markets, and I see our Aussie dollar weakening back to, say, the low 70 cents range on, say, a 1 year view. But in the short run, definitely it seems that seems to be where the momentum is at the moment. In terms of hedging, look, I'm mixed evidence on hedging. I mean, from a long run, look, from a short, if you've got a 3-month view and you probably want to hedge because the Aussie may well push up a little bit further. From a long run investment point of view, it actually doesn't all that much matter because the currency tends to trade sideways. So I don't really have a strong view either way. I mean, maybe have a mix of hedged and unhedged exposures, but I definitely don't see the Aussie trending higher on a 2 to 3 year view, getting up to, say, over $1 US. If anything, it's going to pull back to the low 60, high 60, low 70 cent range would be my my sort of medium-term view.
Mm-hmm. Excellent. And just some quick thoughts on how important cryptocurrencies will be over the next few years.
I, as a rule, hate cryptocurrencies. Again,
that's why I asked that one.
Look, crypto is getting a kick along again. Everything, there's a lot of speculation in the markets, and it's rising from the dead again. I mean, I'm still very dubious about Bitcoin. And a lot of those other currencies. I mean, one of the problems is that there's so many multiple currencies out there. I mean, what killed the dot-com bubble 20 years ago was when these companies got so highly valued, you get all these other companies coming to market, and there was such a flood of supply that it actually then it fell on itself, collapsed on itself. And when you get multiple currencies, cryptocurrencies competing for investor dollars, that's when it can tend to collapse on itself. So again, I know there's some tech people out there that see it as the new future, but ultimately I think it's not going to rival fiat currencies. Governments will clamp down on that should that ever be a threat, and it's going to limit their usability. So I'm not the person to ask in terms of wanting to invest in cryptocurrencies because I'm not really a believer.
But certainly they are popular. We've got a few questions here, and you did mention quite a bit on that stubbornly low inflation rate and banks not meeting their targets. The questions relate to whether the RBA will reverse their decision for a 3-year hold. So do you think they'll back away from that? What's your thoughts there?
Yeah, look, it's an excellent question, and I actually think they well, as I've argued, I think asset prices are likely to get out of hand before price inflation gets out of hand, or consumer price inflation. So I have a suspicion that that by late next year, or even early, or certainly early 2022, if we do get the sort of gains in house prices that I suggested we could get, and the equity market gets a major kick along, that they may start to change their tune on that front. So I actually think 3 years is just so amazingly long to imagine that we could keep them where they are. Certainly, if the economy is recovering, then I think yes, they will eventually change their guidance.
Mm-hmm. And do you see the opportunities increasing demand for Australian companies related to the green energy trend, and then investments more generally in that space?
Yeah, look, I didn't mention this, but I mean, this is a major investment theme, what has been, and it will be certainly now with Biden taking the presidency. I think all things green energy, alternate energy, are definitely going to come to the fore. We're going to see a lot of investment activity. I mean, again, I haven't mentioned as a theme, I mean, our ethical funds, we have a few funds that screen out fossil fuel producers, and companies that are engaged in gambling, alcohol, and tobacco, these sort of things, and they've actually done incredibly well in the last few years. Because energy companies have not done so well, and tech has done very well, and tech tends to have a low carbon footprint. So just through the nature of the sector exposures, you can be ethically invested and have a green energy element to it, and still have a very good investment performance. Certainly, that's what our ethical funds have done. But I think what we'll see over the next year is more focus on not just ethical investing, like things that screen out, things like gambling, alcohol, and tobacco, but things that screen in companies that are really pushing ahead with alternate energy, energy conservation, anything to sort of promote climate change. They'll be very hot new investment themes, and so watch this space, I think, in terms of that area.
Mm-hmm. Excellent. And quite a few, your comments on gold.
Yeah, gold, I haven't mentioned. Look, I have been earlier this year. I was positive on gold. Ultimately, gold I see as a bond yield story. So when bond yields were declining, gold was rising. When bond yields basically bottomed out a few months ago, and in fact have gradually started to increase. So US 10-year bond yields have gone from a low of about 0.5% up to around about 0.8, 0.9%. Now, so they've actually almost doubled in yield, although they're still very, very low. Gold's come off, and gold's come off even though the US dollar has come off. So again, to me, that just underlies the fact that it's this yield story that's been driving gold. Now, with the risk on sentiment, I mean, if the base, I'm encouraged about the global outlook. I think bond yields have bottomed, and if anything, going to drift up gradually from here. So I don't see a case for gold. And again, I'm a believer in low inflation, so I don't see gold going up because of a return to high inflation anytime soon. So, at the moment, I don't favour gold, pushing on to new highs and rebounding strongly. I think it's probably peeling back somewhat. But again, it's still, depending on your view, we definitely have gold ETFs, and one of the benefits of gold is that if things do go pear-shaped, it is going to be one of the assets that do very, very well if central banks need to come back with even more quantitative easing. So as a diversifying asset within a portfolio, it certainly has a role. But if you're asking me for the direction on my base case view, I think it's probably sideways to gently down from here.
Thank you. We have taken a little bit more time, and I think we'll close it off there. We've done, I think, about 40 webinars this year. Dave and I were doing them weekly at the peak of the crisis. So we thank you very much for joining us, for your input, feedback, and we really do hope you join us next year and answer a few short questions at the end of this session to really help shape the agenda. wishing you a very safe, enjoyable break at the end of the year, and we'll see you next year. Thank you very much.